Congress passed a law last summer, and most seniors have never heard of it. And not because it's secret, but because it's one paragraph buried inside a 500-page bill with a name most people only remember from the headlines. The One Big Beautiful Bill Act. Verified card. Source: congress.gov, H.R. 1, signed July 4th, 2025. Everybody heard about the parts that made the news. Almost nobody heard about Section 7103, the part that hands every American 65 or older a brand new tax deduction worth up to $6,000, $12,000 if you're married and both of you qualify. My name is Kevin, and this is not a bill working its way through Congress. I know some of you are skeptical of new law videos. I've seen the comments. Just introduced usually means 6 months after never. I hear that, and honestly, that skepticism is earned. Plenty of bills get introduced with fanfare and quietly die in committee, never touching a single person's actual tax return. This is different, and I want to be precise about why. This already passed. It's already law. Signed on July 4th, 2025. Not proposed, not pending, signed. And the tax return where it applies for the very first time is the one due next April. If you don't know it exists, you cannot claim it. And the IRS will not remind you. Nobody at the IRS calls you up and says, "By the way, you left $6,000 on the table." That call doesn't happen. The refund you didn't know to ask for simply never arrives. Let's fix that today. Here's exactly what this deduction is, who actually qualifies, how it stacks on top of deductions you already knew about, and the one mistake that can shrink it down to nothing without you ever realizing it happened. First, let's clear up what this new deduction is not. It is not the same thing as the extra standard deduction seniors have gotten for years just for turning 65. That older benefit still exists, roughly $2,000 for a single filer, about $1,600 per spouse if you're married and filing jointly. Verified card. Source: IRS. Additional standard deduction for age 65 plus. Two entirely different numbers, two entirely different sections of the tax code, and here's exactly why that distinction matters. For decades, that older age-based deduction has been the only extra break seniors got just for turning 65. It was modest, it helped, but it never moved the needle dramatically for most retirees. This new provision is a completely different scale of benefit, sitting right next to that older one, largely unnoticed, because it arrived wrapped inside a much larger, more politically talked about piece of legislation. To understand why that happened, it helps to know a little about how a bill like this actually gets built. A bill this size touches dozens of completely unrelated areas of the tax code at once: tips, overtime pay, business provisions, and, tucked into Section 7103, this senior deduction. Verified card. Source: congress.gov, H.R. 1 provision summary. News coverage tends to focus on whichever provision generates the most political debate, which is usually not the quiet ones that simply hand a benefit to a specific group without controversy. That's not a criticism of how the news covers these bills. It's just a reality of how a 500-page piece of legislation gets reported on in a 5-minute segment. The provisions that help the most people quietly are often the ones covered least. This is a completely separate, brand new deduction that stacks directly on top of that one. Officially, it's the Section 7103 senior deduction. Most tax professionals are already calling it the senior bonus. Verified card. Source: One Big Beautiful Bill Act, Section 70103. Here's the number that matters most. Up to $6,000 per qualifying person. Up to $12,000 total for a married couple, where both spouses are 65 or older. Verified card. Source: Kiplinger, OBBBA Senior Bonus Deduction. That's not a tax credit that phases in slowly. That's a direct reduction to the income the IRS taxes you on, stacked on top of every senior deduction that already existed. Let me show you what that actually looks like for a real person. Phyllis is 66, a retired school librarian from Dayton, Ohio. She filed her own taxes for 40 years, same software, same routine. Every February, like clockwork. This January, Phyllis sat down to file her 2025 return, the exact same way she always had. Her tax software mentioned something about a new senior deduction. Phyllis almost clicked past it, assuming it was an upsell. for a paid version of the software. It wasn't. It was $6,000 she was entitled to, simply for being 66 years old, that her own software almost let her walk right past. Phyllis called her daughter that evening, half convinced she'd misread something. Her daughter, a nurse, not a tax professional, didn't know either. They spent 20 minutes on the phone together, reading the software's explanation twice before believing it was real. That's not a story about Phyllis being careless. Phyllis has filed her own taxes accurately for 4 decades. It's a story about how quietly this provision entered the code, buried inside a bill everyone remembers for entirely different reasons. So here's what made this deduction land in law in the first place. Verified card. Source, UHY, Senior Bonus Deduction Overview. It applies whether you take the standard deduction or whether you itemize. That's unusual. Most senior tax breaks disappear the moment you itemize. This one doesn't. If you have significant medical expenses, charitable giving, or state and local taxes pushing you toward itemizing, you still get the full senior bonus on top of everything else. Now let's talk about who actually qualifies, because the age test has one detail that trips people up every single year. You need to be 65 by the end of the tax year, but the IRS uses what's sometimes called the day before rule. Verified card. Source, IRS, age eligibility rules for senior deductions. If your 65th birthday falls on January 1st of a given year, the IRS treats you as 65 for the tax year that just ended, which means some people turning 65 in early 2026 already qualified for this deduction on their 2025 return. Most people in that exact situation have no idea. There's another detail worth knowing, especially if you're helping a parent file this year. You need a valid Social Security number to claim the deduction. Verified card. Source, IRS Senior Deduction Filing Requirements. For the overwhelming majority of retirees watching this, that's not a concern at all. But if you're filing on behalf of a parent or helping someone navigate a more complicated filing situation, it's one more box worth confirming before assuming the deduction applies automatically. And here's something that surprises almost everyone. This deduction is age-based, not Social Security-based. You do not need to be collecting Social Security to qualify. If you're 65 and still working, full-time or part-time, you still get it. Verified card. Source, beancount.io, OBBBA, Senior Bonus Eligibility. Some retirees hear the word senior deduction and assume it only applies once you've fully stopped working. That assumption alone has likely cost some working retirees a deduction they were entitled to the whole time. Let's clear up a few more myths because I've seen all of these show up in comments and questions since this law passed. Myth 1. This is the same as the extra standard deduction seniors have always gotten. False. We covered this already, but it's worth repeating plainly, because this confusion alone causes people to assume they're already getting the full benefit when they're not. These are 2 separate deductions, and you're entitled to both. Myth 2. You have to itemize to claim this deduction. False. Verified card, source, UHY, Senior Bonus Deduction Structure. This is one of the more unusual features of this particular provision. It's available whether you take the standard deduction or you itemize, which is genuinely rare in the tax code. Myth 3. This deduction reduces the tax you owe dollar for dollar, like a tax credit would. Not quite. Verified card, source. Instead, OBBBA, Senior Deduction Structure. This is a deduction which reduces the income you're taxed on, not the tax bill itself directly. The actual dollar savings depends on your tax bracket. A retiree in a 22% bracket claiming the full $6,000 deduction saves roughly $1,300 in federal tax, not $6,000 off the bill itself. Still real money, just worth understanding accurately rather than assuming it's a direct check. Myth 4, and this one matters most for anyone watching, who assumes this is somehow connected to Social Security? Some of the political conversation last year mentioned eliminating taxes on Social Security benefits entirely. Verified card. Source, beancount.io, Senior Deduction versus Social Security Taxation. This deduction is not that. It does not directly eliminate tax on your Social Security benefit. What it does is reduce your overall taxable income, which can indirectly reduce how much of your Social Security ends up taxed, for some retirees, depending on where their total income lands. but it is a separate mechanism, not a Social Security tax repeal. And conflating the two is exactly how a real, useful deduction gets misunderstood into something it was never designed to be. Let me introduce you to Norman and his wife, Carol. They're both 67, both retired from a manufacturing plant outside Grand Rapids, Michigan. Norman spent 31 years on the floor. Carol worked the front office for 26 of those same years. They raised 3 kids in the same house they still live in. Married, filing jointly, both over 65. Under this new law, that's not one $6,000 deduction. That's 2. $12,000 combined, stacked on top of their existing standard deduction and their existing senior add-on. Their accountant, a woman they've used for 15 years, ran the numbers during their usual February appointment. She flagged it before they even had to ask. Between the base standard deduction, the existing senior add-on, and this new bonus, Norman and Carol's household deduction for 2025 landed well above $48,000. Verified card. Source, ourtaxpartner.com, stacked senior deduction example. Before this law, that same household would have been paying tax on $12,000 of income that is now completely shielded. Norman told his accountant it felt like finding money he didn't know was ever missing. That's real money. Every single year this provision is in effect. Not a one-time check, not a rebate. A permanent reduction to what gets taxed, for as long as the law stands. I want to pause here on something important. This is not a stimulus payment. It's not a one-time check that shows up in the mail or gets deposited automatically. Verified card. Source, UHY, Senior Bonus Deduction Structure. It's a deduction, which means it only helps you if it's actually applied correctly on the correct line of a return that gets filed, correctly, every single year through its expiration. Nobody mails it to you. You, or whoever prepares your return, has to claim it. Now, I've thrown a lot of numbers at you in the last few minutes. Stacking rules, age tests, dollar figures for singles and couples, a day before birthday rule most tax preparers themselves only learned about this year. Nobody holds on to all of that from a single video. I wouldn't either, and I write this material for a living. That's exactly why every deduction, every threshold, every stacking rule we cover on this channel lives in one place, written down. Think about the actual cost of not knowing this. Phyllis almost missed $6,000 because a software prompt nearly looked like an upsell. That's not a rare outcome. That's what happens by default every single year to anyone who doesn't have someone flagging these provisions in advance. The quiet rules. Not something you read once and forget by April. The drawer version of what we just walked through, the exact deduction stacking order, the day before birthday rule, the phase-out math coming up next, laid out so you or your accountant aren't starting from zero every tax season. If you're 65 or caring for a parent who is, this is exactly the kind of provision that gets missed. Not because it's complicated, but because nobody flags it in time. Get your copy. The link is in the description below. Scan the QR code on your screen right now, or find it in the pinned comment. 7-day guarantee, always. If it doesn't save you more than it cost you, you don't pay for it. Now, the part of this deduction that can quietly erase it completely, if nobody warns you in advance. The phase-out. This bonus deduction does not last forever as your income rises. Verified card, source, usetax.tools, senior bonus deduction phase-out. For single filers, the deduction begins shrinking once your modified, adjusted gross income crosses $75,000. For married couples filing jointly, that threshold is $150,000. Above those thresholds, the deduction reduces gradually, roughly 6 cents for every extra dollar of income, until it disappears completely at the top of the range. Let's actually walk through that math because it's easier to picture, with real numbers attached. Say a single retiree has a modified adjusted gross income of $90,000. That's $15,000 over the $75,000 threshold. At roughly 6% reduction per dollar over the line, that works out to about $900 shaved off, the full $6,000 deduction. Verified card. Source, ustax.tools, phase-out calculation example. Still a meaningful deduction, just not the full amount. But push that same income up toward the top of the phase-out range, and the deduction keeps shrinking, dollar by dollar, until it hits zero. This is exactly the kind of cliff that catches careful, disciplined retirees off guard, the same way Medicare surcharges catch people who did the right thing at the wrong moment. Let me tell you about Corrine. Corrine is 69, a widow, retired from a regional bank in Charlotte, North Carolina. She lost her husband 4 years ago and has managed her own finances carefully ever since, determined not to make a costly mistake. Her income most years sits comfortably under the single filer threshold. This year, her financial advisor recommended a Roth conversion, converting a chunk of her traditional IRA to reduce future required minimum distributions. Sound advice on its own. Her advisor walked her through the long-term tax math carefully, and Corrine felt good about the decision walking out of that meeting. But nobody connected that conversion to this new deduction before Corrine made the move. The conversion pushed her modified adjusted gross income well past the $75,000 threshold for that year. Her $6,000 senior bonus shrank down to a fraction of what she would have gotten in a normal income year. Verified card. Source: beancount.io. Senior deduction interaction with Roth conversions. Corrine found out when her return was already filed, sitting in her accountant's summary letter, a smaller deduction than she'd expected, with no explanation attached. She called to ask why. The conversion itself wasn't a mistake. The timing, without knowing this deduction existed, was. This is precisely why isolated financial advice, good advice, given without the full picture, can still cost you money. The same way it did for Corrine and for so many retirees. Navigating Roth conversions, required minimum distributions, and now this new deduction, all at the same time. I want to give you one more honest piece of this story, because I don't want you walking away thinking this deduction is permanent. It isn't. Verified card. Source: UHY, Senior Bonus Deduction Sunset Provision. This provision is written into law for tax years 2025 through 2028 only. 4 years, and then it's scheduled to expire completely, unless Congress specifically votes to extend it. That means every tax return between now and the return you'll file in early 2029 is a return where this deduction is on the table, and every return after that currently is not. I'm not going to manufacture panic about a deadline that's still years away. But I'm going to tell you plainly, if managing your income to stay under the phase-out threshold matters to your household, the clock on this specific benefit is already running. Tax law changes like this one have a history worth knowing. Some temporary provisions get extended right before they expire. Others are allowed to lapse quietly, with far less news coverage than the day they were originally signed. Nobody can tell you today which path this one takes. What you can control is making sure you claim every dollar of it while it's still active, rather than assuming it will always be there the way the older senior deduction has been for decades. Let's talk about how this interacts with other decisions you're probably already making. If you're taking required minimum distributions from a traditional IRA, that income counts toward your modified adjusted gross income, the same way Corrine's Roth conversion did. A large distribution in a single year, even one that's required by law, can push you across the phase-out threshold and shrink this deduction without you ever intending it to. Verified card. Source: IRS, Modified Adjusted Gross Income Components. If you're still working part-time past 65, that income counts too. Investment income, interest, dividends, and capital gains all factor in as well, which means a strong year in the market can quietly push a retiree closer to the phase-out threshold, even if nothing about their spending or lifestyle changed at all. This is worth sitting with for a moment. A retiree doing everything right, taking the required distribution the law demands, staying invested the way a good advisor recommends, can still watch this deduction shrink simply because the portfolio performed well that year. It's not a punishment, and it's not unfair in the way a penalty is. It's just a threshold, sitting quietly in the tax code that only matters to the people who know to look for it. Coordinating the timing of a Roth conversion, a large withdrawal, or even when to realize a capital gain against this specific threshold is exactly the kind of planning that separates a retiree who claims the full deduction most years from one who doesn't, even though both of them followed identical, reasonable advice. None of this means don't take your required distribution, or don't work if you want to. It means knowing where the threshold sits before decisions get made, not after the return is already filed. One more layer worth understanding before we get to the checklist. Everything we've covered today is federal. This deduction reduces what you owe the IRS on your federal return. Verified card, source, irs.gov, section 70103, scope. Your state tax return is a completely separate question. Some states automatically follow federal deduction rules. Then others calculate state taxable income independently, which means this new federal deduction may or may not reduce what you owe your state, depending entirely on where you live. Now, this is exactly the kind of detail worth a quick check with whoever prepares your state return, since assuming your state follows federal rules automatically can lead to a surprise either direction. And let's put real numbers side by side, the way Norman and Carol, Phyllis, and Corrine's households look at this differently now. Column 1. Households who know this deduction exists and plan around the threshold. Norman and Carol, $12,000 in stacked deductions, claimed in full because their income sits comfortably under the joint threshold. Phyllis, $6,000 she almost missed entirely, now claimed every year through 2028. Column 2. What happens without that awareness? Corinne, a shrunken deduction, not because she did anything wrong, but because a separate, reasonable decision collided with a threshold nobody told her to watch for. And there's a third group in column 2, worth naming directly. The retirees who never find out this deduction exists at all, and simply file the same way they did last year, unaware there was ever anything new to claim. That group is likely the largest of the three, and the hardest to reach, because nothing about their return will ever tell them what they missed. Every household in column 2 is one conversation away from column 1. The quiet rules holds that conversation written down. The stacking order, the day before birthday rule, the exact phase out, math for your filing status, so the next decision you make, a Roth conversion, a required distribution, a part-time job, gets weighed against this deduction instead of colliding with it blind. The link is in the description below. Scan the QR code on your screen right now, or grab it from the pinned comment. 7 days, full refund if it doesn't earn its place in your file. Now, your action checklist. Step 1. If you turn 65 at any point in 2025, or you'll turn 65 by December 31st of this year, confirm with your tax preparer or your filing software that this deduction is actually being applied to your return. Do not assume it's automatic just because you qualify. Step 2. If you're married and both spouses are 65 or older, confirm the return reflects both bonus deductions, not just one. This is a common software and preparer oversight in the first year of a brand new provision. Step 3. If you're considering a Roth conversion, a large IRA withdrawal, or picking up part-time work, calculate where that puts your modified adjusted gross income relative to the phase-out threshold before you make the move, not after. Step 4. If your 65th birthday lands on or near January 1st of any year, ask specifically about the day before rule for the tax year that just ended. Step 5. Mark 2028 on your calendar as this provision's current expiration year, and watch for any legislative update as that year approaches. Step 6. If you have a parent who files their own return and you suspect they may not know about this deduction, this is worth a phone call this week, not after the filing deadline has already passed. If you've already filed your 2025 return and you're not sure this deduction was included, an amended return is usually still an option. Ask your preparer directly. And if this video helped you catch something your own return missed, email me at kevinexplains.official@gmail.com. Tell me what happened. I'll point you in the right direction. If this is the first time you've heard about this deduction, subscribe before you go. This channel exists to catch exactly this kind of provision, the ones buried in a headline bill worth real money that nobody flags until the filing deadline has already passed. $6,000 is not a small number. $12,000 for a household where both spouses qualify is not a rounding error. It's real money sitting in a section of a law most people will never read, available to you starting with the return you're already thinking about filing. Think about Phyllis for a second, almost clicking past a number, her own software put directly in front of her. Think about Norman and Carol, $12,000 that felt like finding money they didn't know was missing. Think about Corinne and the honest reminder that even good advice needs the full picture to actually help you. The only thing standing between you and that deduction is whether anyone told you it existed in time to claim it. Now you know. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.